Welcome, everyone. My name is Tony Martinez with Latino Tax Professionals Association, and we are happy to bring you yet another informative webinar. Today, we'll be covering ScholarShare 529 plans. 529 plans in general, you may have heard of. This is part of the new Tax Cuts and Jobs Act changes. The 529 plans can now be extended to students who are not necessarily just college, but of a younger age with certain restrictions. But who better to tell us how that works than Julio Cesar Lugo. Julio, can you hear me?
Yes, Tony, how are you doing today? Hello, everyone.
Great. Julio is a TIAA consultant, and he specializes on the ScholarShare 529 plans. He also speaks Espanol, so if anybody's bilingual out there, please let us know. We are live on Facebook. We're also live on Zoom. Type in your questions. We'll be answering them along, and we'll be sure to get you what you need to help you during tax season, also to help your clients throughout the year. That's why we're here, and that's why we do these webinars. With that said, Julio, take it away.
Yeah, thank you, Tony. It's a pleasure to be with all of you. Thank you to Latino Tax Professionals for having us here on this great webinar. We really think that this is a very unique group, and it's very important for our Latino community. So we're really excited and happy to be part of this group and be able to share this webinar with all of you. As Tony mentioned, my name is Julio Cesar Lugo. I am a field consultant with TIAA, Tuition Financing, Inc. We are the program managers of the ScholarShare 529 College Savings Program. And TIAA also manages, outside of California, we manage 9 other state 529 programs. So California being our biggest and the one that I currently work in. Besides that, I've been with TIAA for 3 years now, been in the financial services industry for 8 years now. So have some experience and history within the 529 plans and financial services industry. To move into our agenda, what we're going to be talking about today. So within our agenda, we normally talk about the benefits of higher education with our consumers or our direct participants, future participants. So we'll be giving you a brief just highlight of benefits of higher education, cost of higher education, the whole reason why 529 plans exist, what you can do, different ways to save. Of course, we'll be diving into the 529 college savings plans, qualified tuition program, gift and estate planning, how to get started, how to help any of your clients get started, workplace savings programs. Then we'll end it off with some of our most frequently asked questions. So at the end, we will have some frequently asked questions that we'll get into. But as Tony mentioned, if you have any questions, please feel free to write them in during our presentation, and we'll try to cover them as we go along. So let's go ahead and get started with the benefits of higher education. So by now, it's really common knowledge as far as the benefits of higher education. I don't think, this is going to be any new information or any wow factors as far as what the benefits of higher education are. But this is based on Pew Social Trends and Pew Research. The higher education one achieves as far as receiving a bachelor degree, from a bachelor degree compared to a high school diploma, the greater the lifetime earnings, better job overall satisfaction, career satisfaction, better overall, you notice you have better all benefits through the workplace benefits, higher quality of life, higher income levels, and of course just having the ability to move and progress through the workplace, whether that's through promotions or transferring or moving to a different company that's a better suit. These are all attained and attached with higher education. So again, I don't want to spend too much time here, but when we host these presentations directly to our participants, we like to cover this just to make sure this is the whole reason why 529 plans exist, as well as the cost of higher education. So I don't want to scare anybody here, some sticker price scares, but if you look at the cost of higher education, the cost of higher education has risen for the last 10 years, anywhere from 3 to 6% based on inflation. So when you look at current figures, 4-year public college currently costs about $25,000 for tuition and fees. A 4-year private university costs close to about $55,000 per year. Then two-year community college comes in around about $18,000. And you're looking at, I'm sorry, this is not per year. This is based on the full 4 years of college and two-year community college. When you look at this, we actually project this figure in the blue here. We project it 18 years from now. So this was created back in 2018, projecting it 18 years from 2018 was 2036. So based on 5-year inflation, if tuition inflation continues to rise at the rate it's risen, then inflation and the cost of college for a 4-year public university should go up to about close to $60,000. It's quite shocking when you actually look at these figures. And a 4-year private college can go up to over $120,000. Now, again, we don't want to shock anybody here. It's not to create panic or fright, but there is a real problem with student loan debt in the United States. So let's talk about the cost of higher education currently. Student loans make up $1.48 trillion as far as total student loan debt throughout the United States. The average class of 2016 graduated with $37,172 of student loan debt. And the average monthly payment for a 20 to 30-year-old currently is $351. So student loan debt is the second source of debt for any young adult in their life. The only debt that's larger than student loan debt is a mortgage. But student loan debt for young adults is the second largest debt that a young adult carries throughout their lifetime. That's even larger than auto loans and any other credit card loan. And this was started to shift in 2010. So after 2010, student loan debt surpassed auto loans as far as that second source of debt. So it's quite shocking when you actually look at the figures and the numbers here. So let's talk about what a person can do. And again, we don't want to scare anybody when looking at these numbers. But if you look at these numbers, we get asked quite often by our participants, what can we do if we want to finance 100% of my child's higher education costs and expenses? So based on those inflation figures, based on looking at how much colleges and universities will actually cost, we had to come up with a figure for our participants to know, well, if you'd want to finance 100% of their higher education costs and expenses, and based on when you start, based on the child's age, then these are the figures that you would need to save per month to be able to finance $222,000 for, say, a public in-state university. And this would be covering all costs, not just tuition and fees, but say room and board, books, equipment. So not to scare anybody here, of course, the end game is not to finance 100%. There are financial aid. So there is FAFSA, there is the CSS profile. There are student loans that say if you're not able to finance 100% of a child's higher education costs and expenses. But if you're somebody that would, we came up with these figures so you can take a look at it as far as what it would take if tuition inflation continues to rise the way it's risen. So let's talk about the different ways to save. So there are what are considered UGMA, UTMA custodial accounts. Some of you may have heard of these. These are, say, like your bank accounts, your regular savings account at the bank where it's under the child's name. UGMA, so uniform gift and uniform transfer accounts. They're great accounts for anybody that's looking to create a savings for their child, and at some later moment when the child turns the age of 18 or 21, depending on the state that you live in, and becomes an adult, then these accounts will automatically transfer to the child, and the child will now take over as the account owner. But again, these could be your bank savings accounts. These could be direct brokerage accounts, mutual funds, stock accounts that are in the UGMA, UTMA format. 529 plans also offer UGMA, UTMA accounts. So you are able to set up a 529 plan depending on the circumstance. The second type of account that we normally see parents save money for higher education is through traditional or Roth IRAs. So these would be your traditional IRA that you set up either at a financial institution, at a bank, or some type of brokerage investment advisory firm. Some people like to save money under the mattress, abajo el colchón, the family's general savings account. Say if you have a piggy bank at home, a collective piggy bank per se. So these are the three most common ways that we see that families finance for higher education. Then we also have a 529 college savings program, qualified tuition programs, the custodial education savings accounts, the Coverdell accounts. So the one you choose can really make a big difference when looking at federal financial aid, how much your child will actually be accepted for federal financial aid, and all the other information. We'll cover that in a couple more slides here. Let's go ahead and talk about 529 college savings plans. So essentially a 529 college savings plan is a tax advantage savings plan that was created by the IRS. It's actually section 529 of the US tax code that's considered under qualified tuition program. And it's a savings vehicle that parents, family members, not just parents, but any family member can save for the beneficiary, which could be a child, grandchild, could be anybody in general. It doesn't have to have a blood relationship. They can save for their higher education expenses in the future. So any future higher education expenses for them, they're saving in this program. The benefit of it is earnings grow tax deferred. So any growth grows tax deferred and can be withdrawn tax free as long as they're used for qualified higher education expenses. So these 529 plans are usually sponsored by states, state agencies, or educational institutions. You'll notice there's a difference between direct 529 plans and advisor-sold 529 plans. So direct plans would be, say, our California ScholarShare program. An advisor would be somebody going through directly through the services of a financial advisor. They're authorized by Section 529 of the IRS, the Internal Revenue Code. So to give you an example of that, for the California program, ScholarShare 529, ScholarShare is the official 529 of California, launched in 1999, currently holds 8.5 billion total assets. And like most 529 plans, they offer a limited amount of 529 investment options to choose from. In California, there's 19 different investment options that you can choose from. Every 529 plan will have its own different investment options, its own fees, and its own historical rate of return. Just to provide you with an example of the ScholarShare program. And for those of you that are asking about what are the actual benefits, or what is the actual gift and estate tax benefits that one can have with these 529 plans. Well, with the maximum gift limits, we follow the IRS gift tax rules. So an individual can gift up to $15,000 per year into a 529 program. If they're single tax filers, it goes up to $30,000 if they're a married couple filing joint. You can also super fund a 529 plan. So you can take the prorated over 5-year federal gift tax exclusion, super fund it with $75,000 or $150,000 if they're a married couple, meaning they're not going to fund this 529 plan for the next 5 years. Just important information to point out. So it's considered a completed gift for federal gift and estate tax purposes. You can gift this amount to as many individuals or beneficiaries as you like, and it's subject to the person gifting the amount, not the person receiving it. It's not subject to the kiddie tax. The estate benefits apply regardless if you're account owner or just a contributor, and can help assure that a person's legacy is used for the intended purposes. At this point, this is where we'd say, please consult your tax advisor, but since most of you are going to be tax advisors, CPAs, accountants, you're the right person to talk to about this. So this is the information you would really want to know here as far as legacy, gift, and estate tax benefits on the 529 plans. One thing that I will cover, as Tony mentioned earlier, with the new Jobs Act that mentions that 529 plans can be used for other qualified expenses, which we're going to be going into the expenses outside of higher education. With that caveat there, so in California, if you're in California, the Franchise Tax Board met last year in May, and essentially 529 plans were used for higher education expenses. With the new act that came out, it mentioned that you can use the funds from a 529 plan for K through 12 distributions for private and religious schools. With that, Franchise Tax Board of California met last year and decided not to comply with the federal rule. So meaning the federal rule is that you can use 529 plan funds for the intended purposes of higher education expenses, and on top of that, use it for K through 12 private or religious education expenses as well. In California, if you live in California, and based on the state that you live in, you would really want to take a look at this exception and look at this in a closer detail. In California, if a California resident were to withdraw money from a 529 plan for private or K through 12 expenses, they would be free from federal, any type of paying any federal taxes on the earnings, because it is after-tax money that's deposited into the account. So they would be free of any federal taxes, free of any penalties. They would just be subject to California state income taxes on any earnings withdrawn within the 529 plan, because California decided not to comply with the federal rule. So depending on where you live in, it's good to just search to see what your state, what are the state's guidelines or decisions on the 529, the new 529 Act, the Jobs Act that Tony mentioned. So it's good to just look up that information, see where your state stands on that. So let's talk about the 7 reasons why a 529 plan is a smart way to save for college. So going into a little bit further detail on the 529 plans. Number 1 is tax savings that really add up. So going back to the comparison of the different ways to save for college, say if you were to save in one of those UGMA bank accounts, or say if you were to save in a brokerage account invested in mutual funds or stocks that are under the child's name, if it's used for the intended purposes of higher education, so the funds are used for qualified higher education expenses, then the earnings will grow tax deferred in this account, and you won't have to pay taxes once you withdraw those earnings from the account, as well as your principal contribution, because they're used for the intended purposes that the account was set up for. Say if you were to save in the same amount of money, so in this situation it's you start off with $5,000, you make monthly contributions of $50 per 18 years with an average annual rate of return of 7%. So in this scenario, that's the scenario here that we have in front of us. If you were to save that same amount of money for the same amount of time, at the moment this person withdraws the money from this account, they would most likely be subject to having to pay either taxes on the interest, the 1099 form, or having to pay capital gains taxes on any earnings the account created at the moment they withdraw the money. Because anytime, as most of you know, within the earnings, whenever there's earnings created, if it's not in a 529 plan, there's taxes that would need to be paid on either the interest the account accrued or earnings that the capital gains tax on earnings. So within a 529 plan, you can potentially have up to 25% more if it's used for intended purposes of higher education. Number 2, contribution levels that fit your budget, fit anybody's budget really. So anybody can open up a 529 plan. They have very modest opening contribution, initial contribution levels. You can open an account with $25. There's no requirement for you to transfer money into the account. So within our ScholarShare 529 program, most of the direct programs are managed the same as far as minimum contribution limits. Some advisors have higher contribution limits, but with 529 plans, you can see that most of the direct 529 programs, initial contribution levels are a little bit modest. Some start at 25, depending on which state you're in. Now, on the contrary, as mentioned before, you can go up to $75,000 per individual tax filers on the high end if you're looking to super fund, accelerate a 5-year gift tax contribution, or 150,000 for married couples. So it really falls within anybody's budget as far as depending on what you want to achieve or what your clients want to accomplish with this 529 plan. It can really be an account for anybody. And number 3, you don't need to be a savvy investor to be able to save in a 529 plan. As mentioned before, most 529 plans have a set list or set amount of investment options, so investment portfolios that they can choose from. And you really don't need to be the savviest of investors to be able to select which investment option to invest in. A lot of 529 plans have what are called age-based portfolios, similar to the ScholarShare 529 plan, where it's based on a child's age. It starts off a little bit more aggressively in the earlier years, say 0 to 4 years, and you go through the different age bands. So it automatically shifts the objective of the portfolio and becomes more and more moderate to conservative as the child ages until the child gets to the age of 18, where, as you notice here, go back, half of it will be what's considered our principal plus interest. The other half will be different type of allocations, stocks, bonds, real estate, and international. But on top of this, most similar to the ScholarShare 529, most plans offer single fund options for you to invest in, or multi-fund, and some type of money market, or as what ScholarShare we offer, a principal plus interest guarantee. So there'll be a lot of variety of different options for the investor, for your clients, for yourself to choose from. Number 4, low investment fees. So really, why pay more for something when you don't have to, right? With most direct 529 plans, you can find that the investment fees are minimal. Especially if you're looking at our ScholarShare 529 plan, ours is half the national average, less than a third of the average of the advisor sold 529 plans. And 529 plans, if you look at them as a whole, direct 529 plans have different ways of charging fees than some of the advisor sold 529 plans. Some are based on total annual asset-based fees, and some will have different ways of charging the fee in there. But if you're looking at direct 529 plans, the ScholarShare in particular has low investment fees compared to the other 529 plans that are out in the industry. Number 5, flexibility and control. So with the 529 plan, one of the biggest benefits is having control of the account if you're the account owner. So you have the ability, and one of the biggest questions we get asked is, what if my child doesn't go to college, or what if I get what if my child receives a scholarship? What do I do with the fund then? Do I lose my money? And the answer is no. The first option you have is you actually have the ability to change beneficiaries from one child to another if you have multiple children, or another direct relative of the beneficiary. So that means that the money can be transferred from a sibling to a sibling, from a cousin to cousin. It can even go back to yourself if you're the parent. So from the child to the parent, if you want to further your education. A lot of flexibility with the account, so you can always transfer the account from one beneficiary to the other. Keeping with this topic, funds can be used all throughout the U.S. and even across, even funds abroad, so even internationally. So as long as the institution with 529 plans, you can use this at qualified institutions, meaning as long as the institution is accredited by FASA or the CSS profile. And those are 2-year community colleges, 4-year public or private universities. It's going to be trade schools, technical schools, vocational schools. As long as they're accredited by FASA, then you can use the funds from a 529 plan at those higher education institutions. And you can use them for a variety of different expenses. It can be tuition and fees, room and board, books, equipment, computers. You can use them for some of the laptops, the printers, software, any type of expense that's required by the university or institution. And then this is questions that will most likely come up to directly Latino tax professionals: is what are the exact requirements, or what are the exact qualified expenses that an individual can use for 529 plans. This would probably be the most common question that you'll be asked as a tax professional. What are those qualified expenses? Well, if you keep within these guidelines, tuition and fees, room and board, books, and equipment, so it's computers, but it's also equipment. There are some pretty broad definitions there, and I'm sure you can find more information on this and see what previous qualified expenses have been in the past. But if you keep in mind qualified higher education institutions for qualified expenses, and even some schools abroad internationally, as long as they're accredited by FAFSA, and you can use even if you open an account in California, but you live in, say, Minnesota, you're still not restricted to attending any university in California or Minnesota. You can use the funds anywhere across the nation. So you're not restricted by the state that you're establishing the 529 program in. Big difference there. I just want to clarify there are what are considered the prepaid tuition programs, and some of the prepaid tuition programs that are also considered a qualified tuition program will require that you stay within the state that you're participating in, contributing money into that program. So that'll be a big difference between those prepaid tuition programs and a 529 college savings program, is where the funds can be used. So you'd always want to look into that. And just going on with the flexibility and control. So anyone can contribute, not just the parents. It really does take a village to send somebody off to college now. So the great thing about specifically our Latino community is the closeness we have with our family members, with our friends, and we like to celebrate a lot. We like to get together a lot. So with the ScholarShare program and with some of the 529 plans out there, family members and friends, we make it, especially with ScholarShare, we make it easy for family and friends to contribute towards the 529 plan by having what's called an e-gift feature, where family and friends can contribute directly to the ScholarShare program by the account owner can send a link to their email, and they can contribute via that link, or they can mail in a letter. Well, you can mail the family member or friend a letter, and in that letter, there'll be an envelope where they can mail back a check going directly to your ScholarShare 529 account. So we've made it as easy as possible to help family members and friends contribute, say holidays, birthdays, quinceañeras, any type of special occasion. So that's another great benefit of these 529 plans. The account owner maintains control of the account even when the beneficiary turns 18 years of age. So this was a huge benefit for me, especially when I have a 3-year-old daughter. When I was looking at different types of savings programs for higher education, this means for me specifically, my daughter can't go backpacking through Europe, take a leap year, and decide to use this money that's saved for her for that travel or or other expenses outside of higher education. Because I'm the account owner and my daughter's the beneficiary of the ScholarShare 529 plan, then I have total control of the account. She has to go through me to be able to request money from the 529 plan. This would be the same for any other account owner and beneficiary relationship, to be able to withdraw money and pay for those higher education expenses. So the last one here that we have is withdraw funds for other purposes. The only other purposes that I can think of right now is we've seen is Wi-Fi. You can use the funds, 529 plans, to pay for Wi-Fi and those college application fees that can get pretty expensive. So those would be the last two that I would note on there as far as qualified higher education expenses. And 529 plans are considered financial aid friendly. We'll go over that why in a minute. So if you look at federal financial aid, and I'm not a financial aid counselor by any means, we'd always, of course, we'd want the actual parents and the students to talk to a financial aid counselor at the university that they're looking at. But what we've noticed, and this is based on financial aid information directly from their website, is that whenever a student has money in their account that's under the student's name, let's say in a UGMA account or UTMA account, that can reduce financial aid by up to 20% of the account balance annually. The reason for it is considered student assets. So it has to do with the expected family contribution, the way that that FAFSA looks at student assets. So whenever the student has any type of account, say if it's a bank savings account or any account that's under their name, and they withdraw the money, or they show the statement to FAFSA, could potentially reduce up to 20% of the FAFSA that they would potentially receive. If a parent withdraws money from their IRA, from the retirement account, as far as, if you remember the account options that we had showed previously, if they tap into that IRA, say if it's a traditional IRA, Roth IRA, it really doesn't matter if it's traditional or Roth, then this can potentially reduce financial aid by up to 50% because it's looked at student income. So it's looked at income to the student, even if it's from the parent to the student. If it's grandparent, it can potentially reduce financial aid by up to 50%. And just one thing to think of, the way FAFSA calculates income is they look at 2 years prior income for both the parents and the student. So if they're going back 2 years, we're in 2019 now, they'd be looking at 2017's income. So this could potentially affect their FAFSA by up to 50%. 529 plans have a very minimal impact on financial aid, so it's considered parental assets, just like any other parental asset that a parent might have. So it can be calculated the same way as any type of bank accounts, any type of brokerage account, any type of, say, stock account that somebody has. What's not considered parental assets on the expected family contribution are retirement accounts or equity in your home. So again, any retirement accounts or equity in your home will not be considered parental assets on the expected family contribution, but 529 plans are treated as parental assets if it's owned by a parent on their application for expected family contribution. There is a difference, and it's important to mention to this group, of grandparent-owned or non-parent-owned 529 plans. So non-parent-owned 529 plans on the federal financial aid are looked at with this amount here of the 50%, whereas it's considered income to the student. The reason for that is on the expected family contribution, because it's not owned by the parents, then it's considered income to the student and could potentially reduce their FAFSA there. So it's important to know, and when you're speaking to your clients, who's going to be the account owner, who's the account for, so that you can provide them with the most accurate information on there. But again, looking at 2 years prior income, what we've noticed is some of the grandparents are doing is they're financing the last 2 years of their grandchildren's higher education. Again, as long as the student does not attend for a 5th year or attend for a master's degree program right after their 4th year of college, that they're financing those last 2 years so that they won't have to report the money from the 529 plan on the FAFSA application. But just important to know that, important to keep that in mind, especially with this group here. Let's talk about how easy it is to get started for anybody that's looking to get started with opening up a 529 plan, a ScholarShare account. We made it extremely easy. Hablamos español. Pueden empezar en español. We have a Spanish website, so it's our ScholarShare website, completely in Spanish, all the information. We offer the direct consultations. We have a 1-800 number in English, and we can also be transferred to Spanish. All of our information you can be found in English and Spanish. We have consultants like myself that speak English and Spanish. So we make it as easy as possible, and our website is very user-friendly, that anybody can find information on there. There's a lot of great information, articles on there. We have a college planning calculator that you can look at. That's really great for calculating how much you would need to save for your child's higher education based on their age. So there's a lot of great information on there. A little bit more information about our scholarship program. We're highly rated. So it's a silver medal rating by Morningstar. Been in the top plans by Saving for College for 1, 3, and 5 year for Q3. And one of the lowest 529 plans, lowest cost 529 plans in the nation. Another big thing to note here, most 529 plans, all 529 plans have lifetime account balance limits. California has one of the highest maximum lifetime account balance limits, being 529,000. And each state, it'll be different from each state to state. It's important to notice that California's maximum lifetime account balance limit is 529,000. A couple other programs we manage here in California is the Workplace Savings Program. We'll be talking about that a little bit here. So with our Workplace Savings Program, we help companies implement a free voluntary workplace benefit with the ScholarShare 529 program, where they can offer the ScholarShare 529 program to their employees free of cost to the employer. And they can offer this as a direct deposit benefit to their employees. We have nearly 1,000 participating employers throughout the state of California and across the US. We also have a matching grant program. So it's relaunching February 1st, 2019. It offers families a dollar for dollar match up to $200 for opening and contributing to a new ScholarShare 529 account. There are some requirements with this program. First being the family household income would need to be less than $75,000. The second being is that they would have to be a California resident at the moment of applying. Third would be that they would need to be a U.S. citizen or a permanent resident with valid Social Security number or ITIN number. And the fourth one would be that they'd have to have a child less than the age of 14 years of age at the moment of application. If you'd like more information on this, you can always look at, we have a specific landing page for this. It's mgp.scholarshare.com. That's where they would need to apply and find more information on that. So just to recap, 529 plan advantages, 100% tax-free growth. So it's a huge benefit for anybody that's looking to take advantage of any earnings, investing and take advantage of earnings in the account. Could potentially be 25% more for college. Contribution levels that fit anybody's budget, really. They're simple to administer, simple to open, simple to select investment options. There's low investment expenses on the accounts. They're flexible, financial aid friendly. And we've also made it easy for anybody that's in California by working with some of the top employers here in the state. And companies are making it easier for their employees as well. Let's talk about our 529 Workplace Savings Program. So some of the companies, there are 529 plans out there that are offering workplace savings programs. California was one of the industry pioneers with the 529 Workplace Savings Program. But the way we work with our employers, there's no employer cost. There's no 5,500 reporting that would need to be done with the IRS. If you remember, contributions to a 529 plan are after tax. So there's no reporting that would need to be done with the IRS for 5,500 reporting because it's after tax contributions. There's no contract required between our ScholarShare 529 program and directly with the employer, the company. So we really make it as easy as possible for these employers to implement this benefit. For the employees, it's very easy as well. We provide all the tools. We provide educational literature, a direct link to the website. They can open an account in 15 minutes, easy for them to enroll. And we go actually on site, host presentations, we attend benefit fairs. So we make it extremely easy for this education to be provided to the employee. Again, we work with over 1,000 companies throughout California and throughout the US. You know, depends on, we have small businesses all the way up to some of the top companies throughout the US, some of those Fortune best employers to work for. So if anybody has any questions on the Workplace Savings Program, please feel free to ask, or if you want to reach out to me directly. We go ahead and get started on the FAQs. Before I get started on that, just wanted to make sure I covered one thing. I know that this is being watched through some of the different states here. One that we didn't highlight or cover here, some states will offer a special tax deduction or a tax credit. So as far as a 529 plan advantage, there are some states that will offer a tax deduction or a tax credit for contributing to their 529 plan. Fortunately, California is one of the 7 states that do not offer a tax deduction or a tax credit for making contributions to the 529 plan. But some states will, and some states are parity tax states where an example would be Arizona, where Arizona, anybody that lives in Arizona can contribute to any 529 plan and receive the special tax deduction on their income. So you would want to look at your specific state tax laws to see if they offer any special tax deduction, any special tax credit for making contributions to a 529 plan. Some states offer a tax deduction if you contribute directly to their in-state 529 plan. New Mexico is one that offers a tax deduction. It's actually quite amazing. I believe it's no limit to the tax deduction if you live in New Mexico for making contributions to the 529 plan, but you have to contribute directly to their own in-state 529 plan. So it's important to make sure I highlight that. And we'll get started on the frequently asked questions here. Just take a sip of water here.
Yeah, this is great.
So who can open or contribute a 529 plan? And again, this is any adult that's older than 18 years of age can open it for any child. Doesn't necessarily have to be a child. So there's no age restrictions or time restrictions with 529 plans compared to other education savings vehicles where they might have an age restriction, similar to like the UGMA or UTMA accounts, that the account will be transferred to the minor once they turn an adult. With 529 plans, there's no age restrictions. There's no time restrictions within the account. So with this, anybody can open it up. Most commonly, you'll see parents opening it up for children or grandparents for their grandchildren, tías for their sobrinos, sobrinas. So it really doesn't have to be a blood relationship as long as they're 18 years or older for the account owner and they have a valid social security number or ITIN, a U.S. citizen or permanent resident. They can open up a 529 plan for anybody in general. We see that with scholarships, companies, if you have anybody that's looking to administer a scholarship, any 501c3 organization, corporation, LLC, any business that would like to open an account and offer a scholarship, we can administer, through our ScholarShare 529 program as well. What kinds of expenses does a 529 plan cover? So again, those are tuition and fees, room and board, books, equipment, related technology. So as long as you stay with those 5 commonly used expenses, you shouldn't go wrong with that. And again, this is going to be the most commonly, I believe, the most commonly asked question that you'll receive as a tax professional is, what are those qualified expenses? At what types of schools can a 529 plan be used? So the key component here is that the institution would need to be accredited by FAFSA. And as long as they're accredited by FAFSA, it could be a 2-year community college, 4-year public-private university. It could be for a master's degree program, doctorate degree program, any type of higher education. As long as it's accredited, the institution that they're looking at is accredited by FAFSA. What if a child receives a full scholarship or does not attend college? Do they forfeit the savings? And with this, if a child receives a scholarship, they can withdraw the same exact amount that the child received the scholarship for. They would not be subject to the federal penalty. They would only be subject to federal and state income based on the taxes. So they would only be subject on the earnings section of it. So any earnings that are withdrawn from the account, if it's considered earnings, they would be subject to federal and state income taxes only on the earnings, not the principal contribution. The principal contribution is after tax money that's deposited. So they can withdraw the same exact amount they received the scholarship for, and they would not be subject to the penalty. The same goes if they were to attend a military academy. So if they attend a military academy, then they can withdraw the funds and the penalty will be waived. They would just be subject to federal and state income taxes, specifically on the earnings. Same thing for unfortunately, say if the beneficiary passes away So for death, they would waive the penalty. They would just be subject to federal and state income taxes on the earnings, but they will not forfeit the savings. The savings account will always be there for them. So the ScholarShare 529 program will always be there for them. We also have legacy accounts. So say if there's no immediate need for these accounts, they want to keep this for any future grandchildren, they can always keep them there. As I mentioned before, there's no age restrictions or time restrictions with these accounts. They can keep them there for any future grandchildren as well. So any other questions? I don't know if there's any questions that came through the chat box, but be happy to answer any other questions as well, except for meaning of life. I'm still trying to figure that out there.
Yeah. Thank you, Julio, for going in depth. Yeah, great. Your contact information. If anybody has any questions, type them into the comment box on Facebook or on Zoom webinar. But if not, please follow up with Julio. His telephone number is on the screen. His email. I learned a lot myself just sitting here and listening to you, Julio, about 529, what a 529 plan is. I know a lot of people do not know what it is and how it benefits you, your client. And what's interesting about, like you said, with the Latino community, it's somebody's birthday, Juanito, and they bring the carne asada, the banda, they throw a big party and they bring these big presents, and which is awesome. That's how we roll, right? But yes. Imagine if you change a little bit about our perspective as a culture and say, all right, instead of spending those $50 on that new toy or $100, here's my 529 plan, just put them in here. And between all the tios and tias and everybody else, hey, you probably have $300, $400, $500 yep. Right off the bat. But I know it's just interesting, just changing how we think overall. But yeah, have you seen that, Julio, before with families doing that?
We've actually done it with my daughter before. The first year when she turned 1, we received probably over 50, 60 gifts, and she probably didn't play with half of them. We probably ended up donating half the toys or half the stuff we got for her. By the second year, we're like, you know what? She has the ScholarShare 529 account, and not to plug the 529 ScholarShare 529 account in there, but it was actually my wife's idea. She said, let's have them, instead of just buying all these toys that last year we ended up donating, we had them just donate or write a check directly to the ScholarShare program, which is something that anybody can do as well. So if anybody is interested in those birthday years, have like the abuelos, the tios, tias, they can write a check or provide you with the money to deposit to any 529 account that you choose.
Yeah, definitely. Great. I don't see any question. There is a comment. Gracias por la información. So people are thankful for the information. Thank you again, Julio. ScholarShare 529. And we'll be seeing you in Vegas, right? This year at the convention?
Yes, we're very excited to be there. So we'll be having our own table there. We'll be providing more information about this as well. If anybody has any additional questions, please feel free to look us up at the convention there. We'll be very excited to attend.
Yes. And we'll soon be announcing the exhibit hall layout and more details of the conference. And we'll be announcing Julio and ScholarShare 529 leading up to the convention. But thank you, Julio, and we hope to see you soon.
Thank you. Thank you for having us. Bye.
Bye, everyone. Have a good one.